you can go years. You go like four plus years of never making a payment and just doing a partial claim over and over and over again.
In October, nearly $230 million of missed mortgage payments were quietly swept under the rug. And this year, the total is nearly $3 billion. None of this really showed up in mainstream headlines, even though the data was sitting in plain sight. Buyers didn't see it, sellers didn't see it, realtors didn't see it, and most housing analysts didn't even know where to look. It's the kind of hidden disaster that makes the market look stable on the surface, while something different is happening underneath. Today, top mortgage analyst John Comisky, the guy who reads all the raw data the public never sees, explains how this happened, why it was glossed over, and what this hidden mess means for the housing market in 2026 and beyond. I hope you enjoyed today's Housing Nerd interview. Hey, John, how you doing today? Welcome to the Housing Nerd.
Good morning, Jason. I appreciate you having me on. Thank you.
Yeah, hey, it's my pleasure. I'm really looking forward to this. I think the viewers, the housing nerds, are going to get a lot out of what you have to say about the mortgage market. So really, before we get into all of the mortgage mess, can you just give everyone a quick intro, who you are and what you've been working on and why you're paying so close attention to the mortgage part of the housing market?
Yeah, absolutely. So I'm John Comisky. I'm the author of the Reverse Engineering Finance Substack. In my Substack, I kind of have two main areas of focus for my writing. One of which obviously is housing, and specifically the mortgage market and the mortgage data. It turns out that the 80% of the country's mortgages are ultimately in mortgage-backed securities, and that the guarantors or insurers of those mortgages, right, Ginnie Mae or Freddie Mac, Fannie Mae, they release that mortgage performance data at a loan level on like 40 million loans in aggregate every month. And if you get this data and you download this data, you can get a really interesting look into what's actually happening at the loan level in the mortgage market. And I do, and then I report on it at my Substack. And then the other area of focus of my Substack is the monetary plumbing, treasury spending, et cetera, which somewhat dovetails with the mortgage market. There definitely is some points of intersection, but yeah, two areas of focus there.
It's so you're obviously deep into this thing. And for the viewers, for the housing nerds out there, maybe we could call John like a true mortgage nerd because he's involved. He dissects this data and breaks it down in a way that you can understand it. The average person can. When you think about the mortgage industry in general, I just read a report from Black Knight. I read it again this morning, and their overall nuance or their overall narrative, I guess, probably a better word, is that everything is fine on the surface. It seems like, and you have to correct me if I'm wrong, because I think this is what the viewers really want to understand. It seems like most people are paying their mortgages on time, like the majority of the homeowners across the U.S., but it also hints that there are some major problems brewing under the surface, especially for FHA folks. So for people that don't follow this stuff like you do, can you break that down? Is the report basically correct? And what's really going on behind the scenes? What's kind of the health of the overall mortgage market?
Okay. Yeah, it's a great question. And I haven't read the report yet, but it's good to see that Black Knight / ICE is kind of coming to the party. A little late, but they're correct. So the way that I break out the mortgage market, right, is you've got your agency mortgages, Fannie Mae and Freddie Mac, and for the most part, there's very little distress in those portfolios. It is growing a little bit, but it's from like super low levels. So there's really for Fannie and Freddie, their collective 30 million-ish mortgages, those are fine. But those are better qualified borrowers, right? Those are folks who have better financial positions, et cetera. Where you start to see distress is in FHA and to a lesser extent VA. But for FHA, the stress is definitely there. Their delinquency rates are very elevated. But what's kind of worse with FHA is that even what FHA reports, or even the headline numbers that I report for what are the delinquency rates and serious delinquency rates for the FHA mortgages in the Ginnie Mae mortgage-backed securities, those headline rates don't tell the real tale because they're being suppressed, or they've been suppressed rather, for the last 5 years because of these incredibly permissive loss mitigation programs that FHA has offered. And as a result, the real distress is considerably higher than what's being than even the high levels that are being reported right now. And now that those loss mitigation programs, the really permissive aspects of them, have ended effective October 1st, we're going to start to see data in the upcoming months where that suppression stops. And then that's when things are going to get real interesting in the FHA market. So yeah, like underneath the surface, particularly in FHA, there is a significant amount of distress, and it's going to start to come to a head over the next year.
Yeah. And thanks for breaking that down. So for the viewers, because this is, for you and I, FHA, VA, Fannie, Freddie, all that stuff, Ginnie Mae, it's kind of like average everyday jargon for us. But for the viewers, can you help them understand more about what FHA is compared to Fannie and Freddie and Ginnie Mae, like how that all works? I don't know if you can break that down for us or not.
No, certainly. So Fannie and Freddie, right? For the most part, if you're a borrower and you get a conventional loan, you're typically putting 20% down. Maybe you're putting less down than that, but then you're paying a considerable amount to do so in upfront fees. But you're generally higher credit score, more assets, lower debt to income ratios. Typically, your Fannie and your Freddie borrowers are in much better position. So that's 30 million of the mortgages that are out there. Then you have VA, which are loans for veterans, right? Then you get a mixture of kind of borrower profiles within the VA. So it's not the borrower profiles are not as strong as they are for Fannie and Freddie, but it's more mixed, and there's a military aspect to it too. The VAs just generally, they kind of perform better than you might expect based on the underlying credit characteristics. But they're less qualified borrowers in the aggregate than Fannie and Freddie, who are going to be your highest quality from a credit perspective borrowers. And then you have FHA. And the thing that makes, that kind of distinguishes FHA, particularly from Fannie and Freddie, is you're not putting 80% down. I mean, you can, but it very rarely happens. For the most part, you're putting 3% down or 3.5% down. And there's a lot of, down payment assistance programs. So there's a large number of FHA borrowers who are effectively putting nothing down on the home. And the credit characteristics for FHA borrowers are, generally speaking, way worse. I mean, that the program is way more permissive. It's part of the point of the program, right? Is to offer a housing financing option for lesser credit qualified borrowers. But as a result, when you look across their portfolio, like the qualifying credit scores are much lower in aggregate than they are for Fannie and Freddie. The debt to incomes are considerably higher. I mean, you have some debt to incomes in the FHA portfolio that are in the 50 to 60% range. There's the credit box is way wider or way larger with FHA, and as a result, you just have a bunch of borrowers who are much more subject to financial distress, right? So if something impacts their lives in a negative way financially, then the mortgage not getting paid is a much higher possibility or probability than it would be within the other mortgage portfolio. So that's kind of how I think about it, and why FHA is kind of both the first place that's going to show distress, and kind of why it's so important as the canary in the housing or the mortgage coal mine anyways.
Got it. Okay, that makes sense. So if I understand you right, you've got the majority of folks out there are conventional. 40 million of the loans that I wrote down, I'm sorry, 30 million of the 40 million are conventional. And then you've got would you call it, how many are FHA, you think, out of the 40 million?
For FHA, the total portfolio is about 8 million, of which about 7 million are in MBS. And MBS being mortgage-backed securities. There's about 50 million total in the United States. 40 million of those are in mortgage-backed securities. The other 10 are held on bank books or held on servicer books or held somewhere else. I just wanted to be clear with the numbers. But for FHA, for the subset that I can see, the 40 million that I can see, 7 million of those are in FHA and mortgage-backed securities.
Got it. Okay. And that group of folks are obviously, like you just said, they're kind of the highest risk credit profile. And as a realtor, I've worked with a lot of these folks. Majority of the time, everything goes okay. But I have, to your point, ran into situations where my client may not even have enough money to move, to do anything. And hey, I've had people actually ask me, John, like, well, can I get the seller to pay for the moving expenses as a buyer? And I asked why, and they said, well, with everything going on, we just don't have the money. And I immediately, it's not my job to tell them not to buy. That's kind of against realtor rules. But I give them some caution and say, you need to talk to somebody about your finances, I think, before you venture into this house. The point being that they are they're very high risk, right? And so, like you said, anything goes wrong in their life, they may not pay that mortgage. And it sounds like that's where you're seeing a lot of stress. Now, when I looked at the data from, I looked at a couple different sources, Wall Street, I looked at Black Knight. I don't know if you had it in your Substack or not, but they said the mortgage delinquency rate for FHA was around 10-12%. Is that right? Of FHA borrowers, that, I guess those 7 million or so that actually have delinquency on their mortgage. Is that right?
Yeah. So of the 7 million FHAs that are in MBS, the delinquency rate last month was like 11%. I think it dipped just slightly below it, but it's around 11%. But it's actually higher than that on the full 8 million. So that other million that's not in mortgage-backed securities, the performance on those was actually considerably worse, because for the most part, they're either held on servicer books because they bought them out of pools for delinquency management purposes, or because they're going to do a loss mitigation on the loan, or the originator screwed something up in the origination and couldn't securitize it. So they're, just generally speaking, that 1 million performs worse. So the total, and if you look at the FHA, the numbers that FHA reports, which are 3 months and 3 months behind, but if you look at them, I think it's like 13, 14. So the delinquency rates are in the low teens right now for FHA. But again, those delinquency rates are being suppressed, or were being suppressed by the loss mitigation programs, which would turn serious delinquencies into performing loans, by the FHA basically paying for it, or by doing a pointless modification.
Right. Yeah, I definitely want to get to that, because that's like, one of the big sticking points I think out there that people really don't understand that's going on, or they probably won't ever realize maybe it's gone on until it's way too late and we're way down the road. So when you think about the other thing that I read recently was that the delinquencies, that they're not counting foreclosures in the delinquency numbers. Is that right? When I say
Um,
they, I mean like the reporting agencies. I don't know if that's true or not, but I thought I read that.
no, I mean, for the most part, they do. I mean, it depends. Like sometimes they'll break those numbers out. Sometimes the delinquency number will include it, but by and large, they do. And to be honest, right, even if they weren't, it doesn't make that much difference because there's not very many foreclosures right now. There's not many FHA foreclosures because, again, until October 1st, for the last 5 years, basically the only way you could get foreclosed on if you had an FHA mortgage was if you either abandoned the property or you completely ghosted your servicer. You just wouldn't talk to them, right? Like you could get foreclosed on, but it was tough. Like it wasn't as low as 9 that gets reported sometimes in that, I think from that Wall Street Journal article. It isn't that low, but it's still like it's meaningfully close to it, right? Like that hasn't happened. And as a result, there's kind of been pent up foreclosures behind that loss mitigation dam, that now that the loss mitigation procedures have tightened, there's going to be a wave of them that hits over the next year.
Right. Yeah. So let's talk about that. The partial claim game, all that extend and pretend. It seems if the way I think of it is it's like a fire hose or garden hose, I guess you could call it, where you kinked it. There's a bunch of water and pressure building behind the scenes, and we've continued to kink the hose. And then at some point that's going to be released. It sounds like what you're saying is that has been released, or the garden hose is being opened up at this point. So can you take the nerds through what is this extend and pretend? What happened and what's the status of it? And kind of what do you see happening in the next few months or year?
Sure, absolutely. So there were 2 primary components to the like super permissive extend and pretend loss mitigation. One was partial claims. And what happens in a partial claim is when a borrower misses, say they've missed, they're 6 months behind on their mortgage, and they're talking to their servicer, and the servicer says, hey, can you make 6 payments and come current? And the borrower says, no, I cannot. But then if the servicer says, can you resume your monthly payments if the arrears were covered, right? If the FHA covered those 6 months you've missed, can you pick up and start making the payment now? The borrower says yes. Then the servicer will do a partial claim. And what happens in that partial claim is the FHA pays the arrears. They pay the 6 missed payments, any other late fees or associated, any other associated expenses with that delinquency. The FHA pays the servicer, brings the loan current, and then the borrower is supposed to then resume their mortgage payment. And sometimes they do, but many times often they didn't as well, over the last 5 years. But that loan goes from a 6 month seriously delinquent loan overnight to a performing loan as a result of that partial claim. And to be sure, it's partial claims. I don't criticize partial claims as a loss mitigation tactic. If you have a borrower that temporarily or that lost their job, but now they found another one, like it's an effective way to keep the borrower in the home when they're likely to actually repay on their mortgage. And then they take those arrears that the FHA pays them, but they tack it on as a junior lien that's payable at the end, either when the mortgage matures or when they refinance the house or sell the house. It doesn't bear any interest, so it's actually creates kind of an economic incentive for the borrower to get this. But it's a valuable tool in the loss mit toolkit. The problem was there's no limit on them, not until October 1st. So over the last 5 years, you could literally get, well, okay, say there's no limit. There's 30% of the principal balance of the loan, but you can go years. You go like 4+ years of never making a payment and just doing a partial claim over and over and over again. And there are examples in the data that bear this out, that show this. There were some borrowers who were taking advantage of the program in this way. So you had these incredibly permissive partial claims. And then even when you stopped making, or even when you hit your 30% cap, uh, you could still do a modification, even if that modification raised the interest rate and raised the payment, right? Which makes no sense from a loss mitigation perspective. But even if it did that, the servicer had to offer it to you and you could accept. And then that modification would bring the loan current to a new modified loan. And then, in all likelihood, if you're a borrower in that scenario, you're not going to make any payments on the modified loan. But then 6 months later, they'd modify it again, capital up, roll the arrears into the loan balance, and so forth and so on. That's why I say, literally, you couldn't get foreclosed on unless you abandoned the property or you ghosted your servicer. There was always a loss mitigation option for you to keep you in that home. But that stopped. That stopped in October. So the key thing that changed, there's two things that changed. One is they made the ability to get what are known as a home retention loss mitigation option. So that would be loss mid options designed to keep the borrower in your home, as opposed to a short sale or deed in lieu, which are called loss mid disposition options. But on the retention options, you can only get one now. You can only get one in a 24-month period. So you can get one partial claim every 2 years or one modification every 2 years, but you can't get more than one every 2 years. So this consistently getting partial claims over and over again, which was happening for some borrowers, that will stop. The other thing is, in order to get that partial claim or to get a modification now with FHA, you have to make 3 trial payments. So you answered yes. If you cover the arrears, I can keep making, or I can start making my mortgage payments again. Well, now you have to prove it. You have to prove it at least three times in order to get the partial claim. And then if you stop paying, well, you can only get one in 24 months. So eventually that's going to lead to other loss mitigation paths like disposition or foreclosure ultimately, if the borrower is unable to pay. So those two changes turn FHA's loss mitigation program from kind of the ridiculousness that it was back to a real legit loss mitigation program that is similar to what it was back in 2019 prior to the pandemic. And that is what the mechanism is that's going to kind of shake the FHA portfolio out of this extend and pretend slumber, if you will, from a foreclosure perspective, and make that real again. Because there just won't be this incredibly permissive loss mitigation that keeps, again, extending and pretending borrowers.
Yeah, I was typing some notes, and then it's great that you reviewed that, because I was curious. Was looking back at your Substack, because I had asked you a question about how many people are we talking about here, or how many payments rather. I think I had asked you, what's the scope of this? And when I calculated it, it looked like there were $231 million in payments that were extended or put on the backside of a loan that were paid by FHA. And that's just in October. And when I calculated it, and you confirmed this on the Substack, it was $2.7 billion so far this year. Is that right? In payments that the FHA has basically said, well, yep, you don't have to really make these. We're going to put them on the backside of your loan.
Yep. That's the order of magnitude anyways. I mean, they're about roughly 30,000 individual borrowers are getting partial claims a month. And it ranges month to month, but 230, 250 a month of the FHA making those payments. It's about right. So yeah, it's about $3 billion a year all total, over a 12-month period.
Wow. And so one of the things I guess I don't understand, I mean, I understand the extend and pretend part just because of political reasons. I can understand it on the surface, but it doesn't seem to be the biggest share of mortgage holders. So why do you think they kept this going so long in just that and make it so and left it so aggressive for such a long period of time when it's not even the majority of mortgages, like if they were to just let it go, the majority of mortgage holders seem like they're making their payments. So like, why do it?
That's a good question. I mean, I think that they initially made them permissive, in the aftermath or the reaction to the pandemic. So I semi sort of get it back in the 2021 timeframe, when they did this. The why, and if they would have ended it after a year or two, then this would just, I think, be a footnote. But why they let it go for 5 years? I think some of it was political, and I think some of it was political because originally this was scheduled to happen in April of this year, and then in January and early or mid-January, like the 15th, 16th, like 4 days before the administration changed, the FHA announced that they were going to extend it a year to next February. And then once the Trump administration came in, they, after a couple months, said, no, we're reeling that in, and we're tightening it even a little further than what was originally planned. I think it was, and we're going to make that happen in October of this year. That's when it's going to change. So I do think that there was some politics that was taking place. I also think that, there's a function, or there's an aspect of autopilot. It's like, why was the Fed continuing to buy mortgage-backed securities into like the first 4 months of 2022? Like, why did they go that long when it was so obvious to everybody that support was no longer needed? I think there's an autopilot aspect that happens where it's just like, once something gets going, inertia takes hold. But yeah, it's ending now.
Right. It sounds that way. So the fire hose or garden hose, I keep saying fire, they just could be garden hose. Why? It's being released, right? So that water's starting to come through the system. The question probably a lot of people want to know, or question people have, is how big is that hose? How big is that water flow? So if everything were to be released right now, that's in partial claims, like people said, hey, now you can't get these, you can't get them as aggressively as you did before. You're not going to be able to kick this can down the road anymore. How many loans are we actually talking about? How many mortgages would be in trouble from this not being able to extend this program?
Okay, so it depends on what we mean by trouble. And one other thing I should point out, it's not just the people who got partial claims or who are continuing to get partial claims that concern me about the portfolio. There's also a tranche of loans that were modified in the late 22 through 24, 25 time period that initially had low rates, but then when they were modified, the interest rate has to go to market, right? So say you had a 4% loan and you get a modification in the middle of 2023 when interest rates are 7.5%, your interest rate on your loan is going to raise. And that makes it really hard for a modification, because the point of a mod is to get payment relief. And it's really hard to get payment relief when you're raising the interest rate by that much. They would combat it by combining a partial claim where they would use like all 30% of the unpaid principal balance partial claim firepower in an effort to try to get any payment relief. But you didn't typically get a lot of meaningful payment relief on those loans. So what happened is now that borrower has a market rate, and they have no more partial claim firepower, which means when, if they fall into distress, they don't have that, they don't have that as an option within a modification in order to get payment relief, making them much more likely to end up in, a short sale or a forced sale or a foreclosure if they get into trouble again. So there's a pocket of loans in the FHA portfolio that reflect that as well. So between those and partial claim folks who are in legit distress and are going to be facing a disposition outcome when when these programs end ultimately, because their finances just, they can't afford the house, right? And with the loss mid support gone, they're going to have to find something else. I estimate that there's going to be roughly 250,000 of these that'll go that path in the FHA portfolio over the next 12 to 18 months. Like, it takes time to play out because, it depends on what your outcome is. It also, all these borrowers get one last shot at loss mitigation that started in October. So nobody is being told they can't get a partial claim in October. I mean, they do have to make 3 payments on it, but they do get a chance to get to one, even if they got a partial claim back in March of this year. That counter reset for them. But so that's the magnitude of the distress that I think is going to we'll call it distressed how, or supply, that supply chain or supply line into or supply channel into the broader housing market. I think it'll ultimately be around 250,000 loans in the FHA portfolio that do that over the next 12 to 18 months.
Okay. Got it. That helps us a lot. You've talked about the modifications, and I think you called it in your Substack, if I remember right, the modifications of doom.
Yes.
Right.
Yeah.
Right. So they were basically taking, I mean, this is insane. They're basically taking people at hypothetically a 3% mortgage and going, well, you can't make your payment at a 3% mortgage. So instead, I'm guessing how they do it is they also probably extend it to a 40-year term.
Oh, they did that too.
Yeah. And say, all right, well, now your rate is 6.5%. And that's a modification of doom, because I would think rarely somebody's going to be able to continue those payments, and they're probably nominally different. Or is it possible that there's a higher payment at that point?
I mean, it is possible. Like, that was never the goal with a modification, but it was not only possible, but it happened within the FHA data. And, that typically modifications where you got a higher payment were more likely to occur just on pure extended pretend, right? Where the borrower was out of partial claim firepower and they're just doing it to stay in the house, right? Like, how many modifications can I get until they're going to ultimately tighten the procedures and then eventually force me to leave the home? But what was very common was, like in the scenario that you described, right? 3 to 6.5%, right? They jack the rate, extend the term to 40. That helps a little in terms of lowering the payment. It's not enough to counteract a 3.5% rise in the rate, though. But then if they apply the whole 30% partial claim to pay down the principal of the loan, you might go from paying, your loan balance was, say, $300,000. Now your loan balance is $210,000. So $210,000 at 6.5 and a 40-year, $300,000 at 30 on a 3%. And, can't do that math in my head. I'd have to do a calculator, but let's just say that lowers the monthly payment by like 3%. It's like, okay, so what? Maybe you can make it. And as a borrower, you probably take that deal because you don't feel like you have any other choice, because you didn't. Like, at that point in the waterfall, if you say no, then you are into loss mit disposition. And if you didn't want to leave your home, and that was kind of what the tragedy of the waterfall was for so long. They didn't have an option which allowed the borrower to get payment relief and keep their 3% mortgage. They do now. To FHA's credit, they have developed it. And in fact, the VA recently has been authorized or given partial claim authority by Congress, and the VA is in the midst of figuring out the rules and regulations and how that's going to work. But I hope that the VA actually implements a payment supplement partial claim program like the FHA, which allows a borrower to get a few years of meaningful payment relief, like 25% payment relief on their mortgage, and keep their low rate, and they don't have to reset the rate to market. But yeah, but for years the FHA didn't have that, and it wasn't an option. And so those scenarios where people would use all of their partial claim budget, they would get minimal to no payment relief. And now they have no options if they get into trouble on that mortgage again, because they don't have any more partial claim buckets. So, so they better be able to make their mortgage payments the rest of the way, or they're going to find themselves facing having to leave the house and loss mitigation or foreclosure.
Right. It sounds like that. Boy. Oh, because I do want to get to that 250,000 number. I think that is very important for people to understand. Before we do that, going back to you said something that like triggered me. 30%, the buy down and the principal.
Yeah.
It sounds like part of that loss mitigation and modification was, hey, we're going to forgive. Is that what they're doing? They're just forgiving 30% of the principal?
No, they're not forgiving it.
Okay.
Like a regular partial claim, that 30% is tacked on as a 0% interest bearing junior lien that is payable when the house is either refinanced, sold, or the mortgage matures at the end of the mortgage if the borrower goes the distance. But I mean, look, objectively, 30% of the UPB at 0% interest that can remain that way for up to 30 years, right? I mean, that's a good deal, right? I would take a 0% interest for up to 30 years all day long. I mean, yeah, that obviously the borrowers who were in that scenario, I'm sure there actually were a few that were financially gaming the system who didn't care about their credit, but most aren't. I mean, most are probably genuinely in distress. They are getting somewhat of a financial benefit out of it, but I don't think most of them were taking advantage of it.
Yeah, I think I saw you on Nobody Special Finance, and you were talking about some folks that had kind of gamed the system and through this, and maybe you point out a couple of houses. I think one was in the Pacific Northwest that it was an FHA loan. They hadn't made a payment really at all since they purchased the house. So it sounds like the majority there were people that need it. And, that makes sense. I mean, they're not taking advantage of it, but they're using the tools that are in front of them to help them stay in the house, I guess.
Yeah. And that distinction is important, right? Because in some ways, from a housing market perspective, the housing market is better off if people were gaming the system, because if people were gaming the system, then when the support ends, they stop gaming, they start paying. You don't see these houses end up in forced sale or foreclosure. But to the extent that the 360,000 partial claims that are being performed a year, right? To the extent that represents like real distress, then, this issue isn't just, oh, well, we've got this 250,000 that needs to release, because it's been pent up from the last couple of years. There's just ongoing stress, and the go forward level of forced sales and foreclosures out of FHA is going to be elevated for a while. But yeah, I think that's probably the case. I think probably people aren't gaming the system that much.
Okay. Well, I guess that's good to hear that they're not gaming the system as much as maybe I thought they were. But to your point, well, I guess at the end of the day, John, I'm sure you and I agree that foreclosures are a natural part of the process in the housing market, and they're a healthy part of the housing market in a way. Like, it's just part of the cycle. It's part of, you've got, you get the yin and the yang, right? You've got good and bad. So it's just, you have to have foreclosures in order to have a healthy housing market. Because if you don't have foreclosures, it's fake. Right. And so that 250,000 number, let's think about that. Like, there are about 100,000 foreclosures, according to Black Knight, that were started in, I think, last month. If there are 250,000 people that are released into the system, that's a good amount. But there are rumblings out there. I keep seeing on different YouTube channels. I've had comments on my channel that say there are like millions, like that people are like, oh, there's 10 million plus people that are going to be released into this system of foreclosures, and it's going to crash the housing market. And I'm thinking, okay, if that's true, maybe it is. I don't know. That's one of the reasons why I wanted to bring you on today. It seems like there's systemic problems in FHA, 250,000 people moving to foreclosure, maybe at some point, perhaps over the next few months, maybe 6 months. But there's like a limit to the distress in that category because FHA only makes up a fraction of the overall mortgage market. Is that a correct assumption overall?
Yeah, it is. I mean, I think the way to look at it is how much is what's going to happen with the FHA portfolio over the next 12 to 18 months. How much of that will influence / impact the other portfolios? Like if it actually has a meaningful impact in terms of like home values and we see significant home value decline, I mean, that's kind of a self-fulfilling or a pro-cyclical effect, right? Like lower home values tends to cause more disposition outcomes for borrowers when they get into distress, right? You're more likely to just say, okay, I'll sell the house under duress if you don't have as much equity, right? So that I think that's more the thing to watch. From a pure data perspective, like I just don't see evidence of 10 million or anything like that in Fannie or Freddie. The delinquency rates there are very small. And while they're bigger, they're not nearly as big as FHA and VA. I just don't see where that 10 million comes from, unless it's a place that I'm not able to see it. I'm not able to see it in the data. So I'm not nearly that pessimistic, though I'm not dismissive of where this could potentially go. Like I keep my mind open to the possibilities of, I don't know, contagion. I don't necessarily think that will happen. I think it'll be more of a continued slow grind down that'll be amplified by the FHA. But I say that there's also the wild card of student loan debt. And when the student loan repayment for the SAVE plan borrowers, which there's a big chunk of homeowners in, when that becomes mandatory again, because they're still in forbearance, right? Like, we've talked a lot about student loan defaults and delinquencies back in the April-May timeframe, and people are still talking about them. But those are for student loans that payment is now required again. And like there's still like nearly 8 million student loan borrowers, and these were some of the higher value student loan balances and the weakest financial position borrowers. But there's still like 4.5 million mortgagors in that group, and they're still in forbearance. So they've not been required to make a payment for the last year and a half. And when they do, and they're forced to make that student loan payment, like it's almost, you almost have to make that more than you have to make your mortgage payment, in terms of consequences to you if you don't, then that too is going to put a healthy amount of additional stress when that happens. When's that going to be? It's a good question. Might be as early as this summer. I'd say that's actually somewhat likely when the new repayment assistance plan for student loans, which was present in the budget reconciliation, the One Big Beautiful Bill Act of August, that created this repayment assistance plan. It'll be implemented next summer. Good chance they'll be shifted over to it by then. Certainly by July 2028, as the legislation required for people to be out of SAVE. But they'll probably be forced to switch to that repayment assistance plan and start making student loan payments in the summer. And that's going to have a pretty significant additional impact on both FHA, and then there's also a lot of conventional NVA borrowers who have those student loans as well. So that'll hit across a broader swath of or put financial burden on a broader swath of borrowers in the mortgage spectrum.
Okay. Yeah. I wanted to get to student loans. It sounds like it all makes sense, right? It's not maybe one thing that could cause massive amounts of forced selling in the market. It may just be over time we see an increase of that, if I understand what you're saying, and the extend and pretend ending in October is one portion or one factor that could drive that. Then you've got some student loan pain, not only in FHA, but certainly in conventional and VA. And then obviously other factors out there that we don't have to go into, but obviously like insurance and property taxes. Don't get me started on that. But property taxes being insane the way they are, especially here in Ohio, I'm seeing a lot of distress there. So there's probably multiple factors driving all that. Then you throw in maybe a AI bubble and, let's go ahead and throw in the mix to job loss, right? So it's like a potpourri of pain, I guess, that could affect it.
Yeah.
Right. So like that student loan thing is confusing to me. I tried to research it and understand it, like why, because it seems like there was a fad going around where it was like, hey, all these student loan borrowers are going to be forced to finally pay. But then I read something in passing recently that said, well, the administration just approved more forgiveness before the end of the year with the purpose of saving the borrower a tax penalty. Because if it was forgiven by the end of the year, there would be some type of reprieve on their tax that they would have to pay on the forgiveness of their loan. And it sounded like there was like, it was caught up in litigation or bureaucracy why they were being forced to pay, but the deadline to actually start paying finally would be at the end of the current administration's term. Am I right there?
Okay. So, student loans are somewhat of a complex beast. There's lots of varieties of repayment plans that are currently out there. And forgiveness there's different ways you can get forgiveness in student loans, right? Like if you're a public sector, like you're a teacher, I think they've got one for public safety. And there's a variety of different, routes where if you work in a certain profession for X many years, and you make X many student loan payments, like maybe 10 years worth of payments, then they will forgive the remaining balance. And really, I think what you were reading references people who were close, but then they got caught up in the litigation that froze the SAVE plan. If maybe they were in the SAVE plan, maybe they couldn't get switched to another one to resume payments, but they wanted to get all their qualifying payments to get forgiveness. They were close, and if they finish this year and get the forgiveness this year, then they won't be taxed on, I don't know, let's say they're going to get $40,000 forgiven. They won't get taxed on that $40,000 as income, which I believe they will be next year. I think the tax on that changed, the tax law on that changes. So I think that's what you're seeing. But those are relatively smaller chunks of the student loan borrowers. The one to focus on is what is going to happen to the borrowers who are currently in the SAVE plan at large, like the 7.7 million of them that are still there. It's when they are forced en masse to get to or go to another repayment plan, and start paying subsequently with that new repayment plan. That's the trigger point that will cause stress, not just in mortgage. It'll cause stress in car payments. It'll cause stress in everything that people have to pay, right? Because pretty much once the government requires that on the student loans, you have to make the student loan payment, or ultimately they'll garnish your wages. Like they're going to get their money one way or the other if you have a W-2 style job. So kind of have to make that. And if you have to make that, something's got to give, right? So that's the thing. That's the thing to look for in student loans.
Got it. Okay. So let's pretend like the student loans accelerate, or they don't accelerate, but all of a sudden people have to start paying them more when they do have to start paying them. That causes pain. You've got the FHA thing going on. You've got everything else in the economy maybe deteriorating. What is your opinion about what the government would do? There's a big narrative that they're going to come in and bail out whatever sector they have to in order to make things keep going.
Yeah.
What's your take on all that, John?
With respect to the FHA, I think they're going to let this play out. I'm not certain of that. And I mean, I am cognizant of the fact that next year is a midterm election year. So, to a degree, you just always have to keep that into account. But I think that, yeah, I mean, I think that they're going to let this play out. And while I do think that this is going to continue to, impact, I think this is going to impact the housing market, right? I'm not personally pessimistic that that's going to be like a GFC style event, where if I was, then I would think that policy intervention would be more likely, but I don't think it'll rise to that level. And as a result, I think that the pain that comes from this will be allowed to play out. But it is midterm, so maybe not if the pain starts getting too deep by the summer of next year.
Okay. Yeah, I tend to agree with you. And the fact is that the market needs foreclosures, and foreclosures and forced selling represent opportunities, in my opinion. As a real estate investor, I think they represent opportunities for not only investors, but first-time buyers.
Oh yeah, for sure.
To go out there and find a home. I know several people that purchased homes from foreclosure in the last few years as owner occupants, and they had tenants in there. They evicted the tenants. They went in and with hazmat suits on and cleaned the place out and renovated the home and to live in it. And they got, when they walked into their home that was renovated, they had massive amounts of equity comparatively to what they would have if they had paid retail. So I think it represents a great opportunity for people. I hope folks take advantage of that. Not take advantage of people necessarily, like distress, but if somebody's forced to sell, well, they're going to sell to somebody. Why not you, right? As maybe an owner occupant or even an investor. But
yeah.
What's your take on the 50-year mortgage? What do you think about that?
I think it's a terrible idea. That's what I think.
Okay.
I mean, look, you don't know exactly how this would play out in practice, but the rates on a 50-year are going to be higher than they are on a 30-year. How much? I don't know exactly but it's going to be probably a good bit higher than it would be on a 30-year. You're building almost zero equity in you already don't build a lot of equity in the first part of a 30-year mortgage, unless you have a super low interest rate, right? You've got a 3% interest rate, you actually do. But you're on a 50-year, you're going to build almost no equity. Yes, you would get the appreciation in theory. So if you lived in that house for 7-10 years, which is, I don't know if that's exactly the average time period that people live in houses, but it's probably not that far off, or maybe 15. Even so, 15 years into a 50-year mortgage, you're not going to build that much equity because it's just so darn long. So yes, you would get home price appreciation over that time if that continues to happen as it has over the last 30 years, which maybe it will, maybe it won't. But you're subject to all of the the maintenance expenses of owning a property. Like, to be honest, if you're building so little equity for that 15-year period that you're in it, you probably are better off renting, because then you don't have to, look, if there's a crack in the plumbing, it's not your responsibility to fix. That's the landlord's responsibility to fix. Yeah. I basically view it as, it really is. It's pretty close to like debt serfdom. Like it's a terrible idea. Like that. This is not the way to get housing prices lower.
Yeah, I agree. I think it would raise housing prices if it was used to any type of degree at all. Hopefully it wouldn't be, even if it was offered. But you make an interesting point. I had a viewer point this out to me about the higher interest rate. It almost would negate any benefit potentially. You'd almost have to think if they actually launched the 50-year that they would lock in the same interest rate or like back pay the servicer or something. I don't know. It wouldn't make sense to have a higher interest rate. Although I think the nature of the consumer in the US is lower payment. I'll take that regardless if it makes sense in the long run.
Yeah.
Unfortunately. But, I'm one, if it was the same interest rate for some reason and it wasn't higher, I had somebody point out to me that, well, if you were a responsible borrower, you could take advantage of the 50-year as like a fail safe for a payment, but then make a higher payment every month in order to, pay it like a 30 or 15-year. But if the interest rate is not the same and it's higher, it would make sense to take that, right? It would be completely useless. I would think.
Yeah. I mean, I don't think they would introduce it if it wouldn't result in a lower payment versus a 30 years. So I think that, yes, the interest rate will be higher, but it won't be higher enough. Like the extra 20 years of amortization will ultimately result in a lower payment, but it also means like you're just not getting any equity in the time period where you're likely to be paying on the mortgage and in the house, unless, to your point, you're paying extra in order to build that equity. So yeah, I mean, from a niche perspective, it may actually be a good product for a select group of borrowers. But I think for most people who would just take it because it's the lowest payments, then it really wouldn't be a good product for them.
Right. What about the portable mortgage? What do you think about that?
And by that, you mean assumability of all mortgages?
No, and I don't know the details of this exactly, but there's from the limited reading I've done, it's that you could take a mortgage with you, the mortgage rate to the next property with you that you buy. Have you heard about that?
Yeah, I think I have. I just haven't done a lot of looking into it. I mean, it's an interesting idea. I mean, I like the idea in general. I think it might be a little hard legally to pull off because, I mean, basically what it is, it's really a loan between you and that financial institution that is periodically secured by different properties, right? So like, I would think putting that together in practice, like the logistics of it might be a little bit difficult. But I'm sure it could be done. And, in that sense, it would be a good thing for a borrower perspective, because if you have it, well, it'd be a good thing for a borrower perspective if you could still prepay it, right? If you could prepay it without penalty. That's the question. But if you could, then yeah, sure, why not? Because then you would be able to take your pandemic era 2.5% rate and go apply it to a property now. So yeah, I think it'll be tough to pull off, but I don't have a problem with the portable mortgage per se.
Right. I agree with you. I think it would be tough to pull off because are you just going to be able to take to carry over the balance that you owe on your current home? Or if you buy up and trade up into a much more expensive home, obviously that's the question, right? Can you use that interest rate on that whole balance that you're going to versus the current balance you have? Because the current balance you have may not help you at all. And I guess, and that's one of the, you mentioned assumable. I've worked with some clients with assumable mortgages before, and it's almost like the banks don't want to do them. They probably don't. It was like an 8-month process, which was completely unrealistic for the seller. And I often wonder why they don't make that more accessible. I think that could unlock some affordability for people, or unlock some golden handcuff type problems we're having now. When you think about a home affordability problem, what ideas do you have? What are your thoughts on that? Like, if you were, in charge of everything, John, like, what solutions do you think are out there that could help younger buyers get into the housing market and just make housing more affordable overall?
I think some of the areas where I would focus would be some of the tax incentives for for investors. I don't understand why we do those. From a policy perspective, if our policy is to have individual people have ownership and be ultimately responsible, like with the ownership rights of the property, then I don't see why we have some of the tax incentives that we have for real estate investors. I think, if we want to have a policy where it's better for people to, I don't know, rent because it just makes more sense from a maintenance perspective for, properties to be mass owned where the maintenance can be done cheaper and it actually gets done, because lots of homeowners don't do their maintenance on their home and that ends up causing big problems for them down the line. Then that's one thing, but that's not seemingly what we want. So I would start with those tax incentives. I would, what else would I do from a policy perspective? I mean, obviously I would make loss mitigation programs realistic, like what FHA has done, because that has an impact on housing prices, particularly in the lower end. That 250,000 homes that will likely release into FHA now hasn't for the last 5 years. There have been, you mentioned real estate investors or first-time home buyers who would go in with a hazmat suit. There's been precious few of those opportunities over the last 5 years because the supply just hasn't been there, in large part because of the loss of it. I don't know. Those are things that come top of mind. I mean, maybe you get the government out of the business of providing guarantees on the mortgage. Yeah, I think that's worthy to explore, to make it where the investors in these mortgages bear credit risk, because that's going to raise the price of mortgages, which will lower it will ultimately lower the cost of housing, all things equal, right? Because it'll have to adjust to a payment level where people can afford, although the last couple of years has shown that it can be, the payments can rise. The overall affordability can get worse than even you think it will. So that, I guess that would be my answer to that question. I mean, to be honest, I don't actually think all that much on, like what can be done to solve the affordability crisis. So it's not a super big area of expertise for me.
Yeah, no problem. No, those are great thoughts. And when you say tax incentives for investors, are you referring to like a 1031 exchange? Is that what you're talking about? Yeah. Somebody on my channel last night, I did a live and they brought this up and I thought, man, I've never thought of that, but they're probably right. They said there's probably a lot of disincentive for landlords to sell their current rentals to potentially a homeowner because of the way prices have ran up and the danger or the potential capital gain tax, right? If an investor like me owns a single family house, they could make a great owner occupied house. I probably don't. And this is actually something I've been dealing with lately. I'm like, maybe I should peel off a couple of these properties, but I bought them at this price. Now they're worth this. They'll sell for this. And I'm going to owe all that capital gain tax unless I roll it into another property. And that keeps me from putting it on the market. And I was like, oh, I never thought of that. I wonder if that's probably maybe one of the reasons why we're not seeing more investor inventory, perhaps. Just an idea though, that's maybe what's something out there.
And why from a policy perspective do we want to encourage that with our tax policy? I don't think we do, but
yeah,
like why have those rules? Make it. I mean, I'd favor taxing capital gains like ordinary income. I wouldn't draw a distinction, and I wouldn't provide like those style of exemptions where you don't have to pay it if you roll it into another. No, just make it payable all the time when you realize, tax it like ordinary income, and then let the market sort out what the right price of things is.
Yeah, I often say this when folks are asking me about, what the government will do. I say, well, it feels like, and I could be wrong, that a lot of the people in charge own a lot of assets.
Yes.
Call me crazy.
No, you're right.
And right.
Yeah.
And they want them to go up, right? They want lower rates. They want higher asset prices. But that's just what they want in order to refinance and buy more assets. And so I think that's maybe one of the things that's going on. But yeah, I think you're right. Less government intervention in the housing market is probably better, even if it's pain for a short period of time or a few years or whatever, probably better off. So you brought up something that I as we kind of end this, I wanted to, because you've been very gracious now, we've been on an hour. Think about the government backing all these mortgages. One of the differences, it seems like from 2008, when everything fell apart, to right now, is that back then, the government came in and rescued Fannie and Freddie from ruin, and the taxpayers ended up bailing it out. It seems like now the taxpayers have already held their hand up and said, we're already going to bail you out because the government is backing 80% of the loans out there, meaning two things. One, the taxpayers will probably, we've already committed to bailing them out. And number two, the chances of everything crumbling to a degree where there are massive defaults and it hits banks is very low because the government's there to backstop everything.
Yeah, and banks don't hold these mortgages on their books by and large. I mean, they do some, but they're largely the jumbo type mortgages that they give to people who own businesses that they want their bank, their businesses to do business with their bank. I mean, banks do hold some mortgages, but they're not to the extent that there was a lot of loss on mortgages as a result of default. It's ultimately the taxpayers who are going to bear that burden because we back, like you said, like 80% of them.
Do you think they're going to come out of conservatorship? Do you think the government's going to release them?
Gosh, I don't know. If you would have asked me this time last year, I'd be like, no way. But I mean, it just seems like it's kind of like, I don't think they should. I think so long as there's going to be an implicit guarantee, then it should be an explicit guarantee and the public should get the sweep of all the profits. But I think I don't know. I'll say, 40-60 it does. And maybe that's too pessimistic from a percent chance it happens. Like it's way more likely than I would have given credence to even 6 months ago that this could possibly happen.
Right. Yeah. So who knows what'll actually go through. It could just be another 50-year mortgage idea that never sees the light of day, hopefully. But like you said, it could be, I don't know. I don't know exactly what would occur, except people claim that the rates would go up. I've heard a lot of analysts say that the mortgage rates would go up because of not having the explicit guarantee. But maybe there's some, jury rigging on the government, from the government end to suppress the mortgage rate or buy it down or something. I guess the last thing though for you, John, I'm curious if you can talk about interest rates, mortgage rates, how those are. A lot of people thought they would come down by now. They haven't really. Do you see those? Because I know you track a lot of treasury stuff.
Yeah.
How do you see that playing out over the next year for the viewers?
I think that they will probably drift down a little. I think the Fed will continue to cut. And obviously that does not mean that mortgage rates will necessarily follow, right? Because mortgage rates are priced, much because they're, when the Fed cuts interest rates, they're cutting it for the overnight rate, right? And mortgage rates are priced much closer to like the 10-year rate than they are the overnight rate. So, and those are the interest rates behave at the short end, at the long end differently, but they're not completely unconnected, right? 10 years from now is just 3,650 overnight days from now. So there is some impact. And I think that as the Fed likely continues to cut, that will also, result in some drift down in the mortgage. But I don't like the spread. I don't think the spread, which is the difference between like the 10-year treasury and mortgage-backed security, like what what you have to pay for your mortgage. I don't think that's gonna get, much tighter than it's already tightened up to this point. Mostly because with the Fed's new program, with the end of quantitative tightening, they're not going to start buying mortgage-backed securities again with the principal that repays on the Fed's portfolio holdings of mortgage-backed securities, right? It's like 18 billion a month from the Fed's 2 trillion in mortgages that principal gets paid. That's from some prepayments, and that's from regular principal payments on those mortgages. And in the past, the Fed would have then taken that 18 billion a month and would have rolled it into buying new mortgage-backed securities in the that are going to be issued in the next next month. But they're not going to do that. They're instead going to take that 18 billion and they're going to buy treasury bills with it instead. So what that's going to mean is, like, QT from a mortgage-backed securities perspective, it's going to effectively continue for the foreseeable future. I mean, maybe ever. I mean, I'm not sure that the Fed really wants mortgages on their balance sheet at all. I think many of the board members don't think that they should be. So the Fed may never buy MBS again. And as a result, the private market's going to have to absorb that. And that's going to tend to keep mortgage rates a little higher than they would be if the Fed were instead a buyer of 18 billion of that every month. So I do think that they'll drift down a little bit, but I don't think we're getting back to the 4s. I don't think that we're getting back to the low 5s. But could we dip below 6 in the next year? It's possible. Yeah.
Yeah, I agree with you. I don't think there's going to be massive relief there. I did read something recently. I thought it was interesting. They claim that, well, if mortgage rates don't come down, there's not going to be a lot of mortgage-backed securities coming off the balance sheet because there won't be as much refinancing and as many people paying off their 3% mortgages. I'm not a treasury expert, so I was like, no, that's kind of started to make sense to me a little bit. But what do you think of that? Does that make sense at all, what I read?
The thing to understand about the Fed's portfolio of MBS is it is super, super low interest rate. Like, they have a ton of the 2 and 2.5% coupon mortgage-backed securities from the pandemic era. They have almost nothing that's like higher than 4% in their MBS holdings. Like, you're not going to get rates refi incentive on a Fed held mortgage or a mortgage in a Fed held MBS. You're not going to see refi incentive on those for rates maybe ever. Right. But does it make a cash out a little more attractive for a borrower who's going to eat a higher interest rate in order to get that cash? Maybe, but it's so far below market that mostly that 18 billion a month is probably going to stay 18 billion a month for people who prepay because life happens, right? You move, you get married, you get divorced, you have a kid. It'll be that, and it'll be people who are just paying their mortgage and the principal component, which, considering how low interest rate those loans are, is not insignificant on those loans. So yeah, rates coming down probably won't actually impact the runoff very much, unless the Fed engaged in large scale asset purchases again, like QE, and started buying up a bunch of long dated treasuries or whatnot, and the mortgage rates collapsed. That might have an impact, but in the absence of that, it's probably going to be 18 to 20 billion a month for years.
Okay, good. Well, maybe in the future we do a video just about mortgage rates, because it sounds like you know a lot about that from kind of behind the scenes stuff. That you talk to a mortgage officer or a loan officer sometimes, and they're very limited in what they can say. They're not going to kind of dive into all this.
Yeah.
So it's very educational. I'm fascinated. I could talk to you all day, John, about this. It's great knowledge for me. So for the viewers, how can they find you? What's the best way to support you and find you online?
Best way to support and find me online is probably at my Substack, johncomisky.substack.com. or it's the title of it is Reverse Engineering Finance. You can also find me on X/Twitter at John Comisky 77. I post there occasionally about the mortgage market and about treasury stuff and Fed stuff and other money plumbing stuff. So those are kind of the two ways that you can come follow me there, or come become a subscriber at my Substack. Get all sorts of interesting treasury data and all sorts of interesting behind the scenes mortgage-backed securities data when it first comes out, right? Like that's my advantage over the FHA's reporting of it. Takes them 3 months to tell you what the full default rate is in the portfolio. I'll tell you what's happening in the mortgage-backed securities last month by like the 9th, 10th of the month when that data comes out.
Yeah, great. If you want the inside track of what's happening with FHA, these extend and pretend deals, the health of the mortgage market in general, you're probably not going to find a better source than John. I mean, just reading his material over the last few months since I became a subscriber is very eye-opening, very educational, and he gives you a lot to chew on mentally. So I highly recommend it. It's well worth the money. Well worth it, John. And you do a great job on that Substack. Really like it. So
thank you. Appreciate that, Jason.
Yeah, you're welcome. And thank you today for everything we've discussed. And I'm sure the housing nerds will benefit a lot from this. And if you're open to it, we can check in again, maybe in several months, and do a temperature check on the health of the housing market and mortgage market.
Absolutely. And what's happening with FHA, the procedures tighten, but it takes a couple months for borrowers to get that one last shot at loss mitigation. Are they going to make the trial payment plans? We won't really know that for a couple of months. So we'll start to know it. It'll start to roll in on the data. But by 3-4 months from now, we should have a good read on exactly how that portfolio is reacting, which will be really telling for the year ahead. So yeah, we should do that.
Great. Awesome, John. Listen, thank you so much for the time, and we will talk to you soon.
All right. Sounds great. Thank you, Jason.